All right, ladies and gentlemen, and welcome back to another edition of the Emerald Financial Group podcast. I'm here with my friend and colleague, Tim Michaelides. Tim, welcome.
Thank you very much, Sam. Glad to be back.
It's good to have you on. Look, if you guys enjoy watching these podcasts as much as I enjoy doing them, then please scroll down and click the subscribe button. It's completely free and it'll really help us out a lot.
Don't forget, if you want to leave a comment about anything we're talking about, love to hear your feedback or even an opinion about what we're talking about. We're always open-minded here about what's going on out there and love to hear from you.
Absolutely. So Tim, we're here today to talk about Dr. Copper. Not a medical doctor, actually a PhD in macroeconomics, Dr. Copper is, because he is incredibly good at picking the direction of, economic growth.
Absolutely, and something we should be analysing very closely at the moment because there's been a big change in that space over the last few weeks. Since January, really, markets have been fearful of an up-and-coming recession. Mm-hmm. Okay, yep. But why now is copper finally falling off? Mm-hmm. And what signal is that giving us? Right, I think we need to analyse that, and it's something that has to be on the forefront of our mind moving forward. So, as Sam suggested, PhD in economics. Why? Okay, well, think about it for a second. Most constructions, most industries in manufacturing will be using copper in one way or another. Mm-hmm. Am I right in saying that?
That is correct, yeah.
The other element to it for me is the high demand for copper, especially future perceived demand in the move to electric vehicles, okay, and EV in general, right? Mm-hmm. So why now? Like that big fall in copper, that's a big shock. Right?
Absolutely. And look, we'll analyze this a bit further, but it's not just copper. It's other base metals as well, soft commodities, all of these, prices that we were told are rallying due to inflation and an overheating economy have really started to fall with the exception of oil and energy.
And that creates a big issue, guys. Like, I was talking about this on my webcast the other day to the clients and, we're going through the scenarios, best case scenarios, worst case scenarios of what's to come. My worst case scenario for equity markets overall is an elevated energy prices in general, so crude being the leader of that. And then everything else falling. So if you see commodity futures continue to fall, we see agricultural futures continue to fall, but crude prices remain high, you think about what that's doing to our exporters. Mm-hmm. So their costs of production goes up because energy prices are probably one of the big things, right? You think about your farmers and diesel costs and fertilizer costs and things like that. Most industries are going to get hurt by higher fuel prices. But then all of a sudden you're selling your services or goods at a much lower price because prices have fallen. Mm-hmm. So for me, that's the worst case scenario for equities, okay? Especially value, because the value side's held up a lot better than the growth side to this point. Mm-hmm. So, one of the things I will be looking for as a forward indicator on the market is crude versus copper.
Yep.
Right. That's probably one of my bigger indicators right now of sentiment.
Yep, absolutely. And I know if you watch this podcast, I sort of talk about monetary policy a lot, but, we're being told that there's all this inflation, that all these prices are going up due to huge demand. But, this really doesn't gel with that scenario. Right. If that was the case, it'd be everything, including oil going up, not everything, everything else falling and oil going up. And to me, it really says they've drunk their own Phillips curve Kool-Aid. The Phillips curve basically describes a relationship between unemployment and inflation. And, to me, it looks like they're saying, well, we've got inflation because prices are rising, and that's because unemployment's very, very low. Now, if you've studied the Phillips curve at all, you'll know that empirical data suggests it's not a strong correlation between inflation and unemployment. And if anything, in the last decade, we've gone through a period of extremely low employment and extremely low inflation, which, would dramatically dispute the Phillips curve. So either the central bank is completely ignorant, the central banks of the world are completely ignorant, or, they're doing their whole tightening cycle for other reasons. But it really does sort of suggest that they're trying to solve an energy supply crisis with tighter monetary policy. And, they say ultimately the solution to high prices is high prices, but how much destruction is going to occur before then?
Well, correct. And, how wrong are they going to get it? So we're seeing the first signs of them getting it wrong now. And we could be talking very differently in a couple of weeks' time. But for me, seeing crude come back up from 105 to 112 over the last week is my first sign that they've got it wrong. Because they have achieved demand destruction by seeing the rest of the commodities fall, but they haven't solved the energy crisis. Now, it's early days, right? We just had the 0.75% increase by the Fed. Early days, we're probably going to get the same thing again by the end of July. But if we continue to see this theme of higher energy prices whilst everything else falls, that's disastrous. That is
absolutely.
the worst case scenario. They've got it really, really wrong then, right? They've destroyed everything else. They actually wanted to just get energy prices down because that would have solved most of the inflation problem. But instead, they've just crushed everything and kept energy prices high. So, I get that's outside of the Fed's power, but perhaps lifting rates this quickly wasn't the solution either.
No. And, I guess it does remain to be seen whether this is all bluster and they're trying to influence sentiment. And they're certainly having that effect because, sentiment on the US economy is absolutely tanking.
Absolutely. So they've got the desired result in that, but not targeted towards the main sector that's going to bring inflation down, which is energy.
Yeah, absolutely. We'll put up a chart on the on your screen now that basically shows a relationship of US GDP growth, in this case, real GDP or inflation-adjusted GDP, and copper prices. Now, we're recording this ahead of tonight's GDP release, which is expected to show quarterly GDP be negative in real terms again for the US economy. And that'll be 2 quarters of negative real GDP growth. Now, depending on who you ask, that's a recession. For me, that's a recession. And, again, it causes one to question the central bank narrative that we've got an overheating economy when, we're actually in recession. If recession is too hot for the economy, then I hate to see what just right for the economy is.
Well, that's right.
To borrow from Goldilocks.
Yeah, that's right. So, looking at nominal GDP at the moment, considering how high inflation is, it's not a good reading to be looking at, is it?
No, it's not.
In our opinion, anyway. So, real GDP being negative and, showing a recession, that's already saying it's here.
Absolutely. So you can see the correlation between copper and growth, and really, usually it's fairly closely linked. But I do want to sort of highlight that when copper peaks and breaks its sort of uptrend movements, you get generally periods of subdued growth. So we can see it peaked basically in the early 2010s, and we had a period of subdued growth to the point where they actually had to reintroduce quantitative easing in 2014 to try and spark the economy. And then again in about 2018, copper peaked as well. COVID was very convenient for policymakers around the world because it disguised that the economy was weakening already leading into the whole COVID lockdowns and things.
Well, yeah. So towards the end of 2019, I actually really remember it well. We had, commodity copper prices falling. We had a flat to inverting yield curve. Everything was setting up for a recession before COVID even kicked in. Before COVID even hit any news line at all. We didn't even really think of the word COVID by then. So it was very convenient for COVID to come along and give central banks a reason to stimulate, governments a reason to stimulate.
Absolutely. And with copper forming a peak, and by looking at this chart, if this is a real peak, it's suggesting a prolonged period of copper stagnation or copper price selling, which would indicate a prolonged period of economic stagnation. The Federal Reserve got a lot of criticism, in the front of the Great Depression in the early 30s for lifting interest rates as they went into a depression. And everyone's sitting there going, wow, those ignorant people in the early 20th century, how could they do something so stupid, and assuming behavior like that would never happen again. And yet, here we are. Mike was saying that there's X thousand, PhD holders working for the US Federal Reserve. It just looks like really poor behavior if they do tighten to the sort of 3.5%, 4% as the government bond yield curves are suggesting.
It feels like they're trying to hammer in a nail with a screwdriver at the moment. So, wrong tool for the wrong job. And honestly, I don't know what the tool is to bring energy prices down in this scenario, but it's definitely not lifting interest rates.
No, and you have to question whether that sort of thing is in the monetary policy toolkit. And you could probably argue that it's not. It's not. If anything, you could argue there are deflationary effects of low interest rates that might eventually bring oil prices back down. But I think a lot of it is outside their scope, outside their realm.
Absolutely. Look, what are the main takes from this, right, guys? So look, if copper keeps falling, and this is one of the things you need to look at, on a weekly basis, if you're trying to work out where the bottom of this market is, how bad this is going to get, one of the indicators that you definitely should be looking at right now is copper versus crude oil. Okay, if crude continues to rise or hold high and copper keeps falling, then that's real demand destruction with cost blowouts on top. So for me, that's a base case of the market actually falling much, much lower than what it is right now. So that's what I'm looking at as an indicator to try and work out how far this market's going to go to the downside this year.
Absolutely. I think that's a good thing to look at. Other key things will be, the US CPI reading on the 13th of July. The number there will definitely have an influence over market movements. We'll be looking for core CPI readings. Evidence is starting to suggest that core will be a fair bit down on headline numbers, which will further throw doubt on the central bank inflation story. And then we'll have obviously their policy meeting soon after that. Yeah.
The other thing that actually is going to be interesting this round is the local CPI readings, because we're hearing a lot of stories at the moment of $11 lettuces and all sorts of things like that hitting the supermarket shelves. So I think locally we might see some interesting inflation readings.
Absolutely.
We're a bit late to the table on that side. So.
Yeah, yep. And there will be some very, very interesting economic data from Australia in the coming months. Yep. We've got arguably issues in the construction sector. Here in Victoria, that's, I think, around 10% of our economy for this state. Big elsewhere as well. Mining margins are going to be squeezed because of the commodities price drop, yet costs remaining higher.
Correct.
We had an announcement from Evolution Mining the other day about a dramatic increase in their costs.
Well, that's a bit of an eye-opener of what's likely to come out of the mining sector for the next 3 to 6 months, I guess.
Absolutely. But just on that, and I do want to talk back on copper. I am a huge longer-term copper bull.
Absolutely.
This sell down will give smart investors a massive, massive opportunity. Copper, mined copper grades are about a third of what they were 20 years ago, and they're only going lower. Global copper production will probably peak in around 2030. Demand will continue to grow after that, and there's only one way that copper prices can go in the next sort of 20 years.
Absolutely.
Yes, they could lull for a few months, maybe a year, maybe even 2 years if there is a prolonged depression. But towards the end of this decade and into the next decade, we will face massive copper shortages.
I 100% agree with all of that, guys. And, you've got to be watching these miners at the moment, because if they keep selling with copper right now, that is going to be one of maybe the last opportunities to really pick up some of these copper miners at cheap prices.
Absolutely. So there could be a golden opportunity in the coming years. You'll have to watch that. But that's something we'll be keeping a very close eye on.
Yeah, absolutely. So short term, be wary of these miners.
Yep.
Longer term, get ready for the bottoms and be ready to buy.
Absolutely. All right, I think we'll wrap it up there, Tim.
Awesome. Another good podcast. Thanks, Sam.
Thank you very much. Hopefully you guys enjoyed it. If you did, drop us a comment. If you'd like to have a chat with us about the services we offer, we'll put our information down in the description. And if you want to hear more about, trying to see where the market's headed and perhaps trying to pick the best point to enter, watch this video here. And we'll put up our colleague Caro's great video on technical analysis and how you can use it to identify a good entry level.
Thanks, everyone. Bye for now.
Thanks, guys. Bye-bye.